Growth stocks have the potential to increase in value fast, but they are also more volatile and risky. Income stocks, on the other hand, provide a consistent stream of dividend income, but the stock itself might not appreciate in value as fast as a growth stock. For these two types of stocks, there are also two different types of investors: growth investors and value investors. Growth investors love it when they see their stock price increase in value, also called a capital gain. They are also more willing to take on a greater risk for even greater reward. Value investors like analyzing a company's metrics and numbers and are willing to wait until it's the right time to buy shares in a company. Value investors are good at discovering great companies who are consistent performers and are likely to stay consistent in the future based on the product or services they sell in the market they are in. You might be thinking that to start buying stocks, you need to have a ton of money or be a millionaire. That's not true at all. You can start by just buying one share in a company. While I'm writing this, I saw that the Nike stock is being sold for $60, Coca-Cola for $46, and Twitter for $21. Now, this is not an endorsement to buy these three stocks. It's just an example that you don't have to spend thousands to get going. Now, with the boring definition complete, let's look at how people get rich with stocks. The four main ways people can get rich are capital gains, dividends, selling short, options trading. The last two require a bit of skill and work, and they are not as passive as the first two. Capital gains are when your stocks gain in value. The beauty of this is that you do not perform any physical labor. It's all passive. Let's say you bought 10 shares of the $46 Coca-Cola stock on Tuesday, so your stocks are worth $460. On Friday, the stocks went up to $52. Your stocks, capital, just increased. Gain. Your investment is now worth $520. So your capital increased by $60. Now, if you own 100 or even 1,000 shares, that $6 increase would look even better. With dividends, you get rich by constantly buying dividend-paying stocks, reinvesting those dividends, and you also enjoy the dividend increases from the company themselves. With dividends, it's more of a snowball effect. In the beginning, your income is low, but after time, it exponentially increases, allowing you to live off your dividend income without you ever having to sell your stocks. Investing to get rich and wealthy should be your long-term goal. Chapter 2. What is the stock market? The stock market is like any other market where buyers and sellers come together to trade in goods or services. Think about the car market. You're the buyer who's interested in buying a new red car. You will head over to the car dealership where you are met by eager salesmen. They show you the latest car models, and after some back and forth, they convince you to put down some money in exchange for a new car. The stock market, or stock exchange, works the same way, but instead of the car being the product, it's shares of stock. The two most well-known stock exchanges in North America are the New York Stock Exchange and the NASDAQ. It's on these stock markets that you can buy shares in companies like Snapchat, Apple, and Starbucks. One of the main differences between the New York Stock Exchange and the NASDAQ is that the New York Stock Exchange offers traditional trading, and the NASDAQ is totally electronic. Traditional trading is face-to-face trading where buyers and sellers of stocks are on the trading floor executing orders. On the NASDAQ, all orders happen electronically through computers and telephones. Many small and up-and-coming companies can be traded over the counter, or OTC. This is where investors can buy and sell penny stocks. In the past, the stock markets were only available to the rich and wealthy among us. But ever since the doors were open to the common folk, it has been one of the main vehicles in producing wealth. There have been many times in history where the market crashed and people ended up losing all or most of their money. A stock market crash strikes fear in the hearts of many stockholders because many shareholders have their retirement and wealth invested in the stock market. Why does the market go up and down and crash every couple?